Welcome back to the Wall Street Podcast.
Our focus today comes from the Wall Street Journal Weekend Edition, September 27th to 28th, 2025.
And what are we digging into?
We're looking at some major shifts, think new federal tariffs, key economic signals, and also the growing financial risks around this huge AI infrastructure build-out.
Okay, let's start with those tariffs. The president announced a big one, 100% on patented pharmaceuticals, unless companies build here.
That's right. And the immediate impact, well, it's creating a split.
Absolutely.
Larger players, think AstraZeneca, Amgen, they either expect exemptions or they're already moving. Amgen, for instance, put $650 million into U.S. and Puerto Rico manufacturing. So they're likely fine.
Okay, so they're insulated, who's not?
It's the smaller biotechs. They often use overseas manufacturers, and they just don't have the cash, the significant capital to suddenly build plants here.
So that 100% tariff could really hurt them.
Devastatingly so. It almost clears the path for the big guys. And interestingly, economists are a bit skeptical this will even spur the level of domestic production the administration wants.
Right. So policy trying to force domestic building on one hand, but let's pivot to this other building spree, AI infrastructure. The journal calls it one of the costliest ever.
Oh, absolutely. We're talking hundreds of billions flowing into data centers, chips, energy, and a lot of debt piling up.
Can you give us a sense of the scale?
We'll take one example. A single AI factory still being built in North Dakota. It's pegged at $15 billion.
$15 billion?
Yeah, that's about a quarter of North Dakota's entire annual economic output for one factory.
That sounds speculative. What's the risk there? Is the revenue matching this spend?
That's the core issue. The current AI revenue is frankly relatively tiny compared to these investments.
So there's a gap.
A big one. One VC estimate suggests consumers and companies need to buy something like $800 billion in AI products just over the next 3 to 5 years, mind you, just to make these chip investments pay off reasonably well.
Okay, let's broaden out. How did the market react to all this? Tariffs, inflation still sticky, yet stocks went up Friday.
Yeah, the S&P 500 climbed 0.6%. It seems investors are maybe a bit desensitized to the initial tariff noise.
They expect changes later?
Possibly. They might see it as an opening bid. Plus, there's still strong optimism about the Fed cutting rates again, maybe October, December. That seems to be the bigger driver right now.
But is that optimism grounded? I mean, the Fed's preferred inflation measure, core PCE?
Still stuck, yeah, 2.9% above that 2% target. It's proving stubborn.
And consumers.
Their sentiment slipped back to lows we saw in April. They're citing worries about the job market slowing down. And yes, these new tariffs.
So you have sticky inflation, worried consumers, but optimistic markets. A bit of a disconnect.
Exactly. It suggests maybe the market is looking past the immediate headwinds, focusing solely on potential Fed action.
Let's go back to the AI debt for our last Q&A point. Can you put some more hard numbers on that risk?
The figures are staggering. Just the hyperscalers, Google, Amazon, Microsoft, they're projected to spend almost $400 billion on capital investments next year alone.
$400 billion.
Yes. To put that in perspective, that's more than the entire Apollo space program, adjusted for inflation.
Wow.
And look at commitments. OpenAI is talking about annual server payments, maybe $60 billion a year to Oracle. Their current revenue is around $13 billion.
So they're betting massively on future growth.
They have to be. It implies a belief that a fundamental economic transformation driven by AI has to happen, and happen quickly, to make sense of these numbers.
And this is having real-world impacts right now, isn't it? Especially on energy.
Absolutely. This AI boom is putting huge strain on the U.S. power grid. It's exacerbating an existing crisis, really.
What are we seeing happen?
Well, some states, like New Hampshire, are actually deregulating parts of the utility sector specifically for off-grid providers, hoping to spur innovation and meet this demand without overloading the current system for everyone else.
And meanwhile, other tariffs are hitting consumers.
Yes, things like heavy trucks, home goods. Kitchen cabinets saw a 50% tariff mentioned. So you, as a consumer, are likely to see higher prices on big purchases soon, tied to that protectionist policy.
So wrapping this up, we have this tension. Policy pushing domestic manufacturing, while private money floods into AI demanding massive infrastructure the current system struggles with.
It's a fascinating dynamic. You've got this regulated protectionism clashing with, well, unrestrained tech speculation, and it really forces the question, does this conflict create some unique new opportunities for growth, or are we just looking at a potentially huge misallocation of capital and risk waiting to unfold?